5.5 million new American businesses were registered in 2023, a record. The data for 2024 hasn't been released yet, but most predictions suggest this record could be broken again. Meanwhile, every pre-revenue, pre-idea, pre-clue startup that vaguely mentions artificial intelligence is getting billions of dollars from wealthy investors. But there's a problem you may not have noticed. Fewer companies exist today. In 1996, 8,090 companies were publicly traded on US stock markets, a record. Nearly 30 years later, there are less than half as many publicly traded companies, despite a threefold larger economy and sevenfold larger market. There are many hypotheses about what is happening, from private equity rendering Wall Street obsolete to corporate mergers eroding typical investors' wealth. But there are greater challenges. Where did all the corporations file? Bed Bath & Beyond is closing hundreds of stores and filing for bankruptcy, and some tech companies go public too soon. We still see lots of opportunity to change and grow the business. Yes, lots. At the time this movie was released, 34.1% of the S&P 500's market value was made up of 7 companies: Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, and Tesla. Standard & Poor's data shows that Berkshire, Broadcom, and Walmart represent over half of the market in 10 firms. In 2015, the top 10 companies held 16.2% of the market. Market concentration within the biggest businesses tripled in less than a decade. More publicly investable enterprises would matter less. This trend hurts investors, workers, consumers, and even companies. Getting ahead of myself. First, we must understand why. Most commentators note the rise of private equity. Private equity is a firm that invests in companies or assets not listed on public exchanges like the Nasdaq or New York Stock Exchange. We've covered the details in several videos. As private equity firms manage 120% more money in America than in 2000, market share has been taken away from public exchanges for many companies because it's not worth it to meet the compliance requirements of public listings, which require early investors in management to listen to thousands of stockholders instead of just 1 or 2 big private equity firms. The ordinary investor has little money and holds most of their shares through managed retirement plans. Those retirement funds invest in private equity too. Unless the company is huge, going public doesn't provide anything over selling to a private equity group. Even when they desire to profit from their investments, private equity firms are increasingly selling their assets to bigger ones. Apollo, one of the largest private equity firms, reports that over 9,000 enterprises have been supported by private equity since 2000. If these companies had to raise money through an IPO, the number of public companies would match history. Mystery solved, right? Wrong. One narrative goes beyond private equity wrecking everything again. Having the same number of enterprises as 30 years ago doesn't explain the larger economy. If businesses and commercial activity were linked, there would be 25,000 public companies, yet there are only 4,000. Companies and their ownership are becoming more consolidated. Much significant companies listed in America and much of the world today have BlackRock, State Tree, and Vanguard as their top shareholders. There are many thumbnails about these corporations being wicked empires plotting world dominance, but that's probably not true. Indeed, they manage assets for millions of investors. That's not theirs. Most investors who desire diversified market exposure, but cannot buy and balance hundreds of shares individually, since it would take too much time and money, find their index investment products convenient. This reality may be less interesting than an evil empire in the shadows, but its growing popularity is nevertheless harmful to your finances. See why we're going. Be Wendover Productions for a moment. According to public 13G filings, the Vanguard Group owns millions of shares in Delta, Southwest United, and American Airlines, mostly on behalf of its index products. According to commercial aviation data firm AOG, American, Delta, Southwest, and United control more than 70% of the US air travel market. To grow their business, these companies should offer lower prices, better service, or more convenient routes to one of the other 3. This is the foundation of good, healthy competition, and in the battle days, shareholders owned one company, but now that their largest shareholders own an equal stake in every other business in the market, they are less eager to crush their opposition. Delta might steal market share from United if they compete on all routes. However, their stockholders have only lost profit margins to win a war against themselves. Instead, the growing pool of shareholders who own stakes in all of these companies will be financially better off if they grow their margins by cost-cutting service, charging more fees, and confusing bookings, if that ever happens. The stockholders aren't even helped by this little game, so this isn't the real picture. Finding out how many works will explain why companies are dying. Alert, heated take. If they are well regulated and not in important industries, monopolies can benefit consumers for a while. Netflix was great for a few years when it dominated streaming. The price was low, And you could access an extensive library of on-demand content without the challenges and risks of sealing the high seas. But Disney, Apple, Paramount, NBC, Universal, Amazon and Warner Brothers saw the opportunity and started locking their own content with subscriptions. Today, to access a complete library of content, you would need 5 or 6 subscriptions, easily costing more than the cable it was supposed to replace. Even the studios did better under Netflix because they could license their content for additional revenue instead of losing billions of dollars trying to take market share. Really, this is nothing new. Many businesses enter new markets with new technologies, but few endure. The Dutch, British and French East India firms were state-sanctioned monopolies from the start, since that was the only way they worked. Current businesses use their own funds to adopt new marketable technologies, instead of raising funds and founding a new company. Netflix is the only big streaming company that wasn't a film studio or technology company before entering streaming. The message is, huge is wonderful. Amazon offers same-day delivery and global cloud computing. Brick-and-mortar businesses could operate in a few locations, but to compete with Amazon would require hundreds of billions of dollars in warehouses and delivery centers. With their smaller scale and higher expense, legacy brands like Toys R Us and Bed Bath & Beyond can't compete on price or convenience as well as Amazon. Users gravitate toward the largest suppliers in any specialty since social media, like Meta brands, only have value if everyone uses the same service. If you want to shout about how hard it was back in your day, under Minion memes, go to Facebook. If you want to shout about how hard it is now, under Bernie memes, go to Reddit. If you want to shout about how hard it is to synergistically integrate the joint development into regional self-layoff project, go to LinkedIn. Much of the planet. Even if we're brilliant at monopoly whack-a-mole, they'll keep appearing. Because many investors are the same on both sides, companies are less resistant to acquisition, and a single unregulated company should earn better returns than 2 organizations that must compete. Growth is natural for businesses. Big corporations have more money to invest in growth and prospects, so if they can't produce something from start, they'll acquire it from someone who can. Private equity's increasing role in broad market asset managers has hastened this. However, another group prevents many enterprises from being founded. Ironically, venture capital is a private equity niche that funds startups rather than large companies. In theory, plenty of venture capital activity should spur new business growth, but the sector has discovered it doesn't maximize results. The best approach to make money is to rapidly scale a business and hope big tech corporations buy it. According to a Journal of Information Economics and Policy study, this practice systematically inhibited innovation because enterprises were supported to be sold, not to provide value. If one of these companies starts a competing service, the problem arises. Venture capitalists avoid it because it's too risky. The established company with vast capital reserves can compete with a startup until they run out of cash, then resume business. Kill zones, as The Economist called them, make it hard for startups to get investors if they threaten big enterprises. The most ironic part is that corporations with more market power are terrible for customers because they can price control, and even worse for employees who may only have 1 or 2 organizations where they may use their expertise. Private equity venture capital and asset management businesses have grown between investors and the companies they invest in, making the great business extinction worse for investors. Commissions, fees, consultation fees, and performance incentives have increased. Finance income used to account for 3.5% of GDP until the early 70s, but now it accounts for over 10%, according to the Bureau of Economic Analysis. These institutions' assets have expanded from less than 50% of GDP in 1980 to over 180% now. Many of these firms are too big to fail, not too big to fail. Regulation should address skewed incentives. The FTC last broke up a corporation in 1984 with ATT. Since then, the sole punishment for anti-competitive market power has been penalties. If you've only learned that finance dudes are soaking up more of our economic activities, watch this video to learn what these jobs do. It's different than you think. Be sure to like and subscribe.